So, ladies and gentlemen, in today's video, I'm going to teach you the best SMC strategy that has a 99% win rate. And listen, this is the strategy that most SMC gurus use to make a whole lot of money, and I myself have jumped into this strategy to make pretty decent amount of money on a demo account. But don't worry, that's fine. Just stick around with me and I'm going to show you what I mean in a short while. You know, we're both forex traders, so just in case you don't want to be like this guy.
Brother, what's that? What's that, brother?
Listen up to me. So we have the charts here, and I'm just going to give you a simple example of how the forex chart works. Now, the first thing you need to do once you jump into a market, having little or no knowledge, trying out the strategies, identification of the institutional bias. Now, what does it mean? Basically, it is to identify the market trends or the direction of the market. Now, you know, when a market is making higher highs and higher lows, it is on an uptrend. Then when the market is making lower lows and lower highs, it is on a downtrend. Now, I drew this, that's why you can see all these things. I deliberately drew it, but I just wanted to state out an example. So you must have heard me say higher highs and higher lows a whole lot of times. Now, that is the direction of the market. This is an uptrend and this is a downtrend. Now, this is more like a demand zone. So this is more like a demand zone. Now you see price came all the way from here and tapped into this demand zone. And now you can see also price came back here to tap again to this demand zone. Now remember, I drew this. This is not a real price. This is just me drawing it. What I see a whole lot of people do many a times is maybe, I mean, you saw the market from here went to the downside. Sometimes people could get into a trade here, targeting, let's say, something like this, because they've seen that the market is going to a downside or to the downside. And I'll be honest with you, this is a bad trade because yes, even if it could go into your favor, one thing you should know is that you should learn to trade with the trend. I forgot to mention, we need to identify time frames, trying to identify the direction of the market. So once you're identifying the direction of the market, we have to look at the time frame. So let's say we're working with a daily time frame. If this is a daily time frame, then let's say this movement in the daily time frame could create something like this in the 45 minutes time frame, or maybe the 1 hour time frame. Why? Because the time frame differs, so it could create something like this. Now, in this movement, this is like a correctional move. You don't want to be trading against the trend because maybe in the 4 hours time frame it looks something like this. No, you don't want to trade against the trend. What you simply want to do is wait for the next key level, and you know, with time we're going to get to that. Now, how will you know key levels? Now, there's a rule in the market that says buy low and sell high. Now, what do I mean? It means if you want to buy this trend, this should be your point. This should be the point in which you should target for buys. Here is one point. Here is another point where you're going to target for buys, and also here should be absolutely another point where you're going to target the buys. Now, these are places where you're going to target the buys. Now, if you want to target a sell on this other move, here is a point because we're selling high and we're buying low for sells. Then here is another point. I'm sorry, all these are the exact same color, but I just hope you can differentiate them. The blues are where we're going to go in for buys, and the reds are where we're going to be going in for sells. So you don't want to go in for a buy somewhere like here. You're already late to the party. I mean, it could still come back and go to the upside, but who knows? Maybe you could, if you're not really a good trader, you could place your stop loss. Maybe if you go for a buy here, you could place your stop loss a little bit beneath. Let's say you're targeting for a 1:2 risk to reward, and you could place your stop loss. Let's say, okay, this is a 1:3. Yeah, the trade will go to your direction, but it's going to hit your stop loss first, and in return, you lose the trade. So you don't want to be doing that. Instead, you want to get into the market when it is low. So the point in which it has come, when it has had a correctional movement. Now, how are you going to know? Okay, how are you going to know that, yeah, this market is not going to break below this? How are you going to know? That is what we're going to come in later when we're going to look at the live charts. But for now, we're just going to stick to that. But let me give you a little hint. Most times, if the market has done a correctional move before, on most cases, it's going to also do another correctional move in a place that is close to that range. So you can see it's also going to do another correctional move in a place that is close to that range. So as long as it has come here and it has gone down, when it goes down the second time, most likely it's going to still come back to this same level and stop. That's how it works a whole lot of times. So these are places where we want to enter for buys. We want to enter for buys here, we want to enter for buys here, and so on and so forth, because we've identified the overall direction of the market. It is going up. Now, like I said, sometimes there is something called an internal move or an internal trend. And I'm going to give you an example. Let's say, okay, let's shift this. So let's say the market now does something like this. Now, just to be clear, this is, if the market does something like this, is this an uptrend or a downtrend? It is clearly a downtrend. It is clearly a downtrend. And like I said, we're going to be looking for sales in places like this. We're going to be looking for sales here. We're going to be looking for sales also here and here, and so on and so forth. You get the gist. So these are places that we're going to be looking for sales. Now, what you're not going to do is, or what a whole lot of traders mistakenly do sometimes, is that they could want to be looking for buys here. And let me change the color back to blue. Now, they could want to be looking for buys here. They're looking for buys here. They're looking for buys, let's say, this area. These are the places that they're looking for buys. And I mean, the trade could still go according to your plan, but it is not really a good thing when you're looking for buys somewhere like here. Look, listen, remember, we are still following the overall direction of the trend. And if this is a daily time frame, on a daily time frame, the trend is bearish, and you don't want to do something that is contrary to a bearish trend. You don't want to buy when the overall trend is bearish. You're trading against the trend. That is a very big mistake that you can do. And these kind of things are called internal structures. We can see this. Now, this is an uptrend. Yes, it is an uptrend, but it is an internal structure. It is a trade that it's like, I don't know if you've ever heard the word a trend in a trend. This is clearly what it means. It is a trend in a trend. Now, you could go for buys here. I mean, these kind of things it is preparing to take out your stop losses. So it is wrong to go for buys here, because these are just the markets warming up. The institutions, the big institution and the big banks warming up. They are looking for trades, or they are looking for stop losses to take out of the market. So if you come into a buy here, you could still go to the upside, but at some point it will go down. The market is still on a downtrend. So try to avoid internal trends and internal trades, because these things are the problems with you having a whole lot of stop losses being hit. Back to this, like I said, we should be looking for sells in the high places, and we should be looking for buys in the low places. Now, this is on a downtrend. And now this downtrend, we want to be jumping for sales here, here. What you should not do is, maybe you looked at this point and then you want to jump in for a buy. Nope, that is very wrong. The trade is still on a downtrend. Even if it could act like it's going to the upside, it is just warming up to come to this same zone and tap into this liquidity and still go back to the downside. That is what the market is doing. It's looking for liquidity to tap in and still go back. So it is going to hunt your stop loss. So do not do something like that. So this is a live chart, and what we have practiced with our drawing, let us practice it with the live chart. Now, this is a daily time frame. Overall, is this market on a bearish trend or on a bullish trend? We can see that the market is on a bearish trend. Okay, if we go to the monthly, the monthly looks like it's on an uptrend from the monthly. But you know, we're not going to justify with this, because there are a whole lot of things that make it look like it's on an uptrend. But you know, this is a monthly. A whole lot of times you cannot just judge with a monthly. But if you go down to a weekly, if you pull it out, the weekly kind of looks like it's consolidating. So we're not really going to do too much on that. Then we now come to the daily. I think the daily speaks the most. Now, from the daily, it is clear that it is on a downtrend. We can see the markets making lower lows and lower highs. We are going to be looking for selling opportunities in this market, because it is on a downtrend. We're not going to be looking for buying opportunities, but rather we're going to be looking for selling opportunities. A little mistake a whole lot of people could do, like I have talked about, is you may want to go for a buy here. Yeah, it is good, but remember, you're trading against the trend. The trend is down. The market is on a downtrend, and you don't want to be going for a buy on a downtrend. You're literally taking yourself out for destruction, because at some point it could come downwards, and you never know when it's going to come downwards. That is why you don't want to go for a buy in a bearish market. You don't want to trade against the trend. The only time you're allowed to trade against the trend is one, if you're a professional trader, in which we're not even going to come to that, or you're so sure that the market is or it has had a change of structure. But if the market has a change of structure, then you're not even trading against the trend. The market is still going according to the trend. It's just that it just had a change of structure. So going for a buy at this point in time may not really be the best decision. You would need to wait for the market to give you a new swing high, then you go for the sell. That is what you're going to wait for, and that is like your entry point or your confirmation level or your liquidity level. And then if we step down to the 4 hours time frame, so this is the 4 hours time frame. On the 4 hours time frame, it is still on a downtrend. So you know what we're going to do? Let us mark out the swing highs. Let us mark out places in the 4 hours time frame where we can potentially be going for a sell. This is one of them. Let's change this to red. So that's one of them. This is another. Now this is another. And we also have another one here. These are places where we want to go for sells. We don't want to look for buys. We don't try jumping into a buy here. This is a suicide mission. Don't try jumping into a buy here, or this is a very, very big suicide mission, because it's going to tap into this liquidity and still go back to the downside. So you should not even jump into a buy in this kind of trade. We are looking for selling opportunities. Now the big question is, then when is the time for us to jump into the trade, or when is the time for us to jump into the sells? So let us use NZD-CHF as an example. So where is NZD-CHF headed towards? Now, it is clear that NZD-CHF is headed to the downside. So we don't need too much. We don't need too much analysis. It is headed to the downside. So from the little we've seen, we're looking for selling opportunities, right? Now, another thing in which you need to do is we need to mark out our areas of interest. We need to mark out our supply zone and demand zones. This is one of them. As some traders will call it, the support and resistance. So this is more like a resistance for the ones below and a support for the ones above. Now, let us mark out another zone in which we have seen, which is clearly this. So this is clearly another zone in which we've seen. So these are like the two main key levels, or the two main zones of the market. So at this point in time where the market is here, if we've come to this area of liquidity, at this point in time, we're going to be looking for sells. So maybe if the market came to this area and you went for a buy, you traded against the trend. Now, it could be good. But if you're a genuine trader, you should wait for the market to come here. And as it has gotten again to this area of liquidity, to tap into that liquidity, my friend, this would have been the best time to go for a short position down again to this same demand zone. And it's going to come here to tap into this place before it goes back up. And you've had a good, this is a nice 1:6 risk to reward, which is very amazing. Now we can now come to a lower time frame, and now from the lower time frame, it is still bearish. And as smart money, you're not going to want to buy in this level. No, you're not going to want to do that. It is wrong. So here we have, now remember, this is a daily time frame. Now from this daily time frame, we can now see another liquidity zone, which is here, where the market has come to tap in several times, or it's a key level that has been respected. Now we can pull it a little bit. Now we can see the market came to tap in here and rejected, tapped in here the second time, and now even though it broke below, it came again to tap into this area of liquidity to get some momentum to go to the downside. Now we can see it had a little uptrend Now, these are the kind of things I say. You would not want to buy at this zone because this is a killer mission, okay? You're not going to want to buy here because this is a killer mission. So do not do that. You're going to wait till the market taps into your area of liquidity, and then you can now go for your short positions. When you've gone for your short position, you can, let's say, place it a little bit above here and then go back to this. So this is a nice 1:2 risk to rewards. A whole lot of times I don't take 1:2, I take 1:3. I love 1:3, but if you're still going to take this trade, this is fine. Now remember, this is a daily time frame. We want to know how we can take a real life trade. So we're going to still come down to the 4 hours, and then in the 4 hours it is clearly bearish. It is still bearish. It is not bullish. So from the 4 hours, we're not going to be looking for buying opportunities. We're going to still be looking for selling opportunities. And now you can still mark out some levels, in which some key levels, some demand zones, and this is one of them. This is another. As time goes on, as a smart money trader, every time frame you jump into, you see more key levels and more demand zones of the market in smaller bits and pieces. But remember, overall, we are on a bearish trend, so we're not going to be looking for buying opportunities. I have been saying this over and over again, so you're going to hear me loud and clear. You know, in the Bible, me being a Christian, a whole lot of times when prophets are going to proclaim the message of God, a whole lot of times they stand in the front of the gates of the street where everyone is going to pass, and they say, "Hear me, O Judah and Benjamin, the Lord is with you while you are with him," and so on and so forth. If I were to take this trade, let us draw this together. Now we can see that this is an uptrend, right? We can see that this is an uptrend. So this is a bullish trend. Now remember what I talked about, internal structures. So if we're going to pull this is an internal bullish trend. Now, some trader, this is a 4 hours time frame. Now, some trader would want to trade against the trend and go for a buy. Now, this could be a very stupid thing because you don't even know if the market is going to get to this point. Who knows? What if the market from here gets to this point and goes to the downside? You have literally blown your account. So that is a very wrong thing to do because you don't want to be trading against the trend. I have said this countless times and I will still say it. You're going to want to be looking for buying opportunities. Now, this is what we have seen from this market. I don't know how many of you have seen this, but this is a key level. Now, we saw that the market came to this zone, went above here, and broke below. It came beneath. Now, it's more like consolidating in between these two. And now it has come here and it is here. So, maybe the next thing the market may want to do right now is, due to the fact that it is on a downtrend, so our institutional bias is bearish, the market will still continue doing this. Look at what the market is going to do. Lower lows, lower highs, lower lows, lower highs, lower lows, and lower highs, and so on and so forth. So it's going to continue this bearish move, lower lows and lower highs. You don't want to be getting in for buys. Rather, you want to be getting in for sells here. You want to be getting in for sells here. You want to be getting in for sells. So this is your next sell level. This level is where you should be getting in for a sell. So in this kind of trade, what we're going to do is we're going to wait for the trade to break below and retest these liquidity zone. Come and tap into this liquidity zone again, and then we can now go for a short position because overall the market is on a bearish trend. We can now go for a short position, and then your target will be the latest swing low, which is about here. Oh my God. So this is a wonderful 1:4 risk to reward. So this is like a 1:3. Okay, this is a 1:3, 1:4 risk to reward. And this is NZD-CHF. So this is what we've seen from NZD-CHF. And now, for those of you that trade market structure, you would know that this is a head and shoulder. Now, what do I clearly mean by head and shoulder? So this is the left shoulder, this is the neckline, this is the head, this is the neckline, and this is the right shoulder. So clearly what the market will do is break beneath and retest, come back to tap this liquidity zone, and is going for the sells. So ladies and gentlemen, I think we're going to stop here. Subsequently, I'll be releasing more episodes on the SMC strategy made easy. You don't need a whole lot of names and a whole lot of explanation. This is a diluted version of SMC that is going to make it so easy that you can make a whole lot of money, and it gives you a 99% win rate strategy. Bye for now.